Unusual times and unusual days. An FOMC announcement comes out and the market hardly does a thing. Not typical. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:11 a.m. Central Time, and I am recording this in preparation for the market day of April the 30th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in and see what happened in the overnight following this unusual FOMC response. Well, generally a little bit of weakness, but not anything terribly pronounced. You have all four indices down at least 0.25%, with the Russell and the NASDAQ a little bit more weak. The NASDAQ down about 0.5%. Crude oil up 1%. You have Euro up 0.65%. Bonds down about 1/3%, and gold down about 2/3%. China was down about 0.8. Hong Kong down about 0.9. Japan down large, down 2.69. And then the DAX up marginally, and United Kingdom scratch. In terms of macroeconomic reports for today, you have the typical Thursday unemployment claims. In addition to that, we got core price index, personal spending, employment cost index. Okay, here we go. Chicago PMI comes out after the markets open at 1/4 of. So be aware of that one. That one always seems to kind of surprise people in their morning trading activities. So fairly typical there. And market conditions, really, there wasn't a lot of fear yesterday after that announcement. If anything, there was a little bit of a volatility crush just being taken out, from the anticipation of the announcement, and then just kind of exhausting that air and then nowhere to go. So almost like the end of a fireworks show, and it's like, okay, well, now what? There was no fireworks to speak of. So I don't know what people were expecting, but certainly it was very untypical that there was just no real action in the last hour or so of the trading day yesterday. You have VIX short term at 13.26. That is up a little bit, reflective of a little bit of weakness that we had. You have IVs 23, 29, 25, 36. Really nothing to get excited about there. The only market that had a standard deviation day yesterday was the Russell. And indeed, 2 out of the last 3 days you've had the Russell with a standard deviation move, and really that's the only one that would draw any kind of attention ever since we had that day with the Chinese margin rule changes. So pretty quiet still, and we are still, and let's go to the daily report, we still have a phase 3 higher high, higher low kind of expectation. Obviously, we continue to see these weaknesses that we've been talking about in recent trading days and weeks. We've never dropped our hedge warning status down to a full out 0, which would be normal because we've had these kind of flies in the ointment to where while we still have this higher high, higher low bullish expectation over the intermediate to long term, it has been not a very clean path to higher highs, and even when we get the higher highs, it seems to be marginal and with not very much conviction or volume or institutional participation. IBD status is still confirmed uptrend. GMI index is still 4 out of 6. Active trader market posture still a very bullish active trader posture. So really nothing to be worried about from the primary signals, and yet we still have this kind of wall of worry as we go through each trading day. You look at market timing. And actually, I needed to update this. Actually, the 1-day outlook and the 3-day outlook are all neutral, as well as 2-week. Market posture, S&P, NASDAQ, still very bullish. While the values fell a little bit yesterday, they didn't even fall enough to fall out of the very bullish camp. So kind of keep that in context. Dow still bullish. Russell is bearish, so the one index that has rolled over, and we do take some note of that because the Russell also is the leading tell for where the S&P follows. So that is concerning, and one of those warnings. Our hedge warning status still remains a 0+ normal with cautionary aspects. And we did have a couple more flag warnings come in yesterday. Volatility based, we get market and decline warning, as well as a sharp increase warning fired off. We did have distribution day, and our current count of S&P 7, NASDAQ 6. Again, a major warning signal there. New highs, new lows. We had over 300 new lows yesterday on the New York Stock Exchange, so also a concern there. But you see the risk aversion indicators all still flagging risk on. So, when you put all this together, that's where we come up with a 0+. We still have a, confirmed uptrend, an active trader posture that's very bullish. And yet you have, volatility warnings, distribution day warnings, new low warnings. You've got a number of things that are, not typical of a strongly healthy, all-out bull market. So you've got to take that into context. In terms of specific opinions, option income strategies, VIX is inside the acceptable window. Just consider the potential for increased volatility. Cover calls still. Same opinion, bullish, calling for a 1-to-1 distribution between in the money and out of the money. And then put selling. Perfectly acceptable in this market environment as we see it today to sell puts against the core portfolio basket of stocks that you're willing to own in the position size that you are willing to own it. In terms of sector specific, remember we continue to see relatively flat lines on many of these sectors. So, one weak day and everything looks like it rolls over, and then one strong day and everything turns green. This has been the story for so many weeks now. Energy, financials, utilities, materials, technology, perhaps holding up the best. Perhaps that's the point to make. Sector percent change yesterday. Energy, materials, financials were the ones that held on to positive. Obviously, interest rate sensitive on the financials, especially banks and REITs, which are also part of the financial sector. But still, just we'll call it scratch. I mean, so they did hold up better. Obviously, healthcare, consumer staples, consumer discretionary all got whacked much more severely yesterday. So kind of just understand where the strength is as you're building your watch list and kind of go from there. From an industry group, retail, internet, healthcare, railroads, transportation, followed by biotech are the top industry group rankings from Shadow Trader's chart. So that might be of some help with your watch list. That should do it for today. As always, greatly appreciate your investing in us by liking us on YouTube and sharing what you have found here with your fellow traders. Additional information can be found from the website falconglobaltraders.com. Disclaimers as always. Just hit the pause button if you need more time to review this. And we'll see you back here tomorrow morning before the market opens.